Stop scrolling and lock in. I have watched generations of traders bleed their capital, and I know why you are losing. You mistake hope for a strategy, and that sentiment is the tax you pay for lack of discipline. Unless you master the mental firmware updates required for sustained market survival, your current risk-to-reward ratio suggests immediate retirement is the only viable option. The market does not care how smart you are, how much you have read, or how badly you need a win. It is a merciless mechanism for the transfer of wealth, moving assets from the impatient and the emotional to the disciplined and the calculating. You are either a recipient in this transfer, or you are the source. The market is pure objectivity. Your account balance reflects the cold, unyielding truth of your execution, nothing more. Every dollar lost is a direct indictment of a broken rule, a moment of weakness, or a refusal to see the obvious. I will give you the 20 non-negotiable directives for survival, the code of the master speculator. Ignore them and you will not just fail. You will be systematically dismantled by a force you refuse to respect. The difference between an amateur and a master is not knowledge of the chart. It is the absolute mechanical adherence to a superior set of rules. Your primary battlefield is not the ticker. It is the space between your ears. Most of you are trading based on yesterday's emotion and tomorrow's wish, a guaranteed path to ruin. Listen closely. This is not advice. It is the law of the market jungle. Rule 1. Know the direction of the primary movement. You must identify the prevailing current, the line of least resistance, before you commit a single dollar of capital. Speculators who fight the major trend are like a lone swimmer attempting to fight the tide of the ocean. The trend is not your opinion. It is the collective action of massive capital flows, confirmed by price and volume structure. The professional waits for the market to confirm its direction, eliminating personal bias before entry. The amateur is always convinced he knows better than the market itself, predicting tops and bottoms out of arrogance. You must follow the established movement and never substitute your judgment for the clear verdict of the price structure. The main purpose of the trend is to protect your capital by placing you on the side of momentum. I once watched a man ruin a perfect campaign simply because he could not accept that the primary bull movement had ended. He had made his fortune on the way up, but his ego would not allow him to sell and admit a change in environment. His massive gains vanished, not in one devastating day, but through the slow, agonizing erosion of conviction, a direct result of fighting the relentless downward pressure. He thought he was buying value, but he was merely catching a falling blade. Do not make his mistake. The first duty of a speculator is to preserve capital, and that means respecting the trend. Rule 2. Wait for defined entry structure. Patience is not a virtue in speculation, it is a mechanical necessity. The amateur is always in the market, always trading, always hoping that activity equals profit. The master knows the only profit comes from waiting for the price to reach a critical inflection zone, an obvious area of transition or breakout. You must not trade just because you have capital available. You trade only when the opportunity is so clear that ignoring it is the greater risk. The setup must meet your rule. If it doesn't, you keep your hands in your pockets. Capital lying dormant is not wasted. It is preserved for the moment of maximum conviction. Rule 3. Trade with the line of least resistance. The path of least resistance is the market's trajectory, and you must place your bets accordingly. If the general direction is up, you buy the pullbacks. If the general direction is down, you sell the rallies. Never forget this simple truth. The most profitable trade is the one that aligns with the market's inherent momentum. The crowd attempts to pick the exact turning point which requires genius or luck, neither of which are reliable systems. You must wait for the turn to be confirmed by structural change and volume confirmation before committing. The market will always show you where it wants to go. Your job is simply to ride the coattails of that movement. Rule 4. Cut losses quickly. This is the most fundamental rule of survival. and it is the one most violated by human nature. Your first loss is always your cheapest loss. The instant a trade moves against you and violates your original premise, the market has delivered its verdict. You are wrong. Get out immediately. Amateurs allow a small loss to metastasize into a terminal account killer because they refuse to admit they were incorrect. You must trade without ego. A professional views the stop loss as an operating expense, a small price paid to be proven wrong and save the bulk of his capital. Never, under any circumstance, allow hope to dictate the fate of a losing position. I once held a seemingly small loss on an oil play, convinced that my research was superior to the price action. The loss was manageable at 2 points, but I allowed sentiment to hold me captive. I watched it move 5 points, then 10, until the eventual panic forced me out at a debilitating 50-point deficit. The cost was not just the money. It was the subsequent lack of capital and conviction that made me miss the next 3 major moves. A quick exit saves you from ruin. The delay seals your fate. Rule 5. Let profits run. The true art of speculation lies in holding a profitable position without interference. Most traders exit winners too early because of the fear that a profit will turn into a loss. You are trading for the massive move, the big score that compensates for all the small, necessary losses you take. Once a position is profitable, your job is to use a trailing mechanism to protect a portion of the gain and let the market pay you for your patience. Do not allow fear to snatch away the reward that discipline has earned. The power of a large, long-term trend will carry your position to levels you cannot imagine, but only if you have the courage to hold. Rule 6. Never average down. If you are wrong at the initial price, buying more at a worse price to lower your average entry is financial insanity. This action is the professional hallmark of a losing speculator who refuses to accept his error. Averaging down is the emotional defense of a broken trade. A professional only increases a winning position, pyramiding into strength, never doubling down on weakness. The purchase of more shares in a losing trade is not a strategy. It is a desperate attempt to manipulate the perception of a mistake. If a trade is moving against you, the correct action is to exit and preserve capital, not compound the original error. Rule 7. Use volume confirmation. Price movement without volume is meaningless noise. Price movement confirmed by heavy volume is the institutional signature of a major shift. The strength of any price breakout or breakdown must be validated by the depth of trading activity. Volume is the fuel. The crowd ignores volume, focusing only on the ticker's oscillation. The master analyzes volume to determine if the movement is supported by major capital or if it is merely a deceptive fluctuation. A breakout on thin volume often fails. A breakout on surging volume demands attention. Volume does not lie. Rule 8. Study the general market conditions. No matter how promising an individual stock looks, it operates within a market environment, and the current of that environment affects everything. If the general market is weak, even the strongest stocks will struggle to advance. You must understand the health of the entire field. You cannot afford to be fixated on one ticker symbol, while the entire index is signaling a major reversal. The general conditions act as the tide. You should only attempt to sail when the tide is with you, otherwise your boat will be beached. A true speculator knows that 75% of a stock's movement is determined by the market trend. Rule 9. Don't act on tips. Trading on the basis of whispered information is a guarantee of failure because you are trading without an exit plan, a premise, or a conviction of your own. You become a puppet to another man's greed or panic. The only information that matters is the price and volume data displayed right in front of you. You must do your own work, formulate your own trade plan, and execute based on your own risk parameters. Never trust a source that cannot be verified by the tape. A tip is the market's way of separating fools from their money, offering a false shortcut that bypasses the necessary discipline of self-study. Your conviction must come from your analysis, not from external chatter. Rule 10. Control your emotions. The market preys on fear and greed. These two emotions are the engine of amateur failure. Greed causes you to hold a profitable position too long, allowing it to reverse. Fear causes you to sell a winner too soon or paralyzes you from cutting a loss. The master is an automaton. He executes the plan. You must cultivate emotional indifference. The dollar signs you see on the screen should be abstract numbers, not representations of the lifestyle you desire or the money you desperately need. When emotion enters the equation, logic exits, and the moment logic departs, your capital is compromised. This is the hardest rule, the internal battle that must be won daily. Rule 11. Wait for the critical inflection zone. Every successful campaign begins with an entry at a point of maximum structural advantage. This is the critical inflection zone, the area where the price transitions from consolidation to movement. The professional waits for the definitive break, using the consolidation as a spring that indicates future pressure. The crowd attempts to anticipate the move, entering too early during the consolidation, and then being shaken out by minor fluctuations. You must let the price prove its intent before you commit capital. The trade is easy once the movement is clearly underway. The difficulty lies in the patience required to wait for the proper signal. A proper entry is defined by the price structure, not by your urgency. Rule 12. Capital is your army. Treat your trading capital as a finite army that must never be needlessly exposed. Every loss is a casualty. Every trade is a battle. You must conserve your strength for the major campaigns, the trades that offer the highest reward potential. Over-leveraging or over-trading are acts of financial self-destruction. The moment you commit too much capital to a single trade, you lose your objective perspective because the potential loss becomes too personal. Risk management is capital preservation. Capital preservation is survival. Always keep a reserve. The greatest opportunities often follow the greatest market collapses, and only those with capital reserves can seize them. Stay solvent. Rule 13. Focus on a few markets or stocks. Do not spread your focus across dozens of unrelated instruments. You must dedicate your study to a few leaders that you know intimately. The master is a specialist, not a generalist. Deep knowledge of a few price structures and their corresponding volumes is far superior to shallow knowledge of many. The amateur chases every rumor across every market, resulting in confusion and diluted attention. You must study the rhythm of your chosen instruments, understanding how they react to news, volume surges, and key structural levels. Concentration of capital and concentration of focus lead to superior execution. You cannot follow everything. Follow the things that matter. Rule 14. Don't fight the momentum. The most powerful force in the market is relative strength or momentum. When a market or stock is moving sharply and aggressively, it is telling you that the major capital is committed. Fighting this force is financial suicide. Your only viable action is to ride the momentum until the price structure or volume clearly signals a structural change. The crowd attempts to short a market that is relentlessly rising, convinced it is overbought, or buy a stock that is collapsing, convinced it is oversold. These opinions are irrelevant. The market is never too high to buy or too low to sell, provided the momentum remains intact. Respect the velocity of the move. Rule 15. Understand distribution and accumulation. Every major market movement is preceded by a period of structural preparation. Accumulation by the smart money at the bottom, and distribution by the smart money at the top. This process is visible in the price and volume action. You must learn to read the signs of this institutional flow. Accumulation is characterized by increasing volume on up days and decreasing volume on down days during a defined range. Distribution shows the inverse. The amateur only sees the range, believing it to be random. The professional reads the internal volume dynamics to predict the direction of the eventual break. The market is a constant battle between supply and demand, and the volume gives away the winner. Rule 16. Never speculate when the market is thin. A thin market lacks the liquidity necessary for efficient execution and can result in massive, unpredictable swings from small volume. In these conditions, your stop loss becomes a suggestion, not a guarantee. The professional avoids environments where execution risk outweighs directional risk. The crowd is often drawn to these volatile, thinly traded instruments because of the potential for quick, massive percentage moves. However, volatility in a thin market is a trap. You need an active, liquid market to ensure you can get in and out at a predictable price. Safety comes from depth. Stay where the money is flowing freely. Rule 17. Don't take small profits. The ultimate measure of a successful trader is not the number of winning trades, but the size of the wins relative to the losses. You must train yourself to think in terms of reward to risk ratio. The small profit is the enemy of the big one. Amateurs snatch a small profit to feel good, only to see the position explode in their absence. This behavior is driven by the fear of loss, not by a sound strategy. You are speculating for the big campaign, the profit that pays for all your operating losses and provides your returns. If you cannot let a winner run, you will never compensate for the trades where you are necessarily wrong. Rule 18. Never meet a margin call. A margin call is the market's final, brutal verdict. You are completely wrong, and you have exhausted your capital and your credit. Attempting to meet a margin call is the ultimate act of desperation, throwing good money after ruin. Do not meet it. Take the loss, liquidate what remains, and step away. The decision to receive a margin call means you have violated nearly every rule of risk management. It means you were too large, too leveraged, and too stubborn. When the call comes, the campaign is over. The correct action is to pause, reassess your entire system, and start over with the capital you have managed to save, however small. Rule 19. Record everything. Success in speculation is based on replication of profitable actions and the permanent elimination of losing ones. You must keep a detailed record, a ledger of every trade, the premise for the trade, the exact entry and exit points, and the emotional state you were in. This record is your teacher. The amateur trades from memory and feelings, selectively recalling successes and forgetting the sting of failure. The professional uses his journal as an objective audit of his execution. You cannot improve what you cannot measure. Your record is the only honest conversation you will have about your performance. It eliminates the convenient lies you tell yourself. Rule 20. Stay solvent. This is the ultimate rule, the summary of all the others. The market will always offer opportunities, but only to those who have capital to seize them. Your number one goal, above all else, is the preservation of your ability to trade. If you are solvent, you are in the game. If you are insolvent, you are merely a spectator. Your losses must be small, your leverage contained, and your patience absolute. The power of compounding only works when the principle is intact. You must view the market as a permanent career, not a single, desperate gamble. Survival is the precursor to success. The 20 non-negotiable directives decode the institutional flow, proving that absolute adherence to volume confirmation and defined price structure eliminates emotional entry points, replacing them with mathematically sound probabilistic edges. Every failure I have witnessed, every fortune squandered, was the direct result of a speculator believing he could ignore one or more of these principles. I watched a man, a talented analyst, violate Rule 17. He could not let his profits run. His small, consistent wins masked the fundamental flaw. He was unwilling to allow the market to deliver the massive compensating trade. He made money for years, but one single, unavoidable, systematic loss wiped out his net gain because he lacked the one major winner to act as a buffer. He did not go broke on his losers. He went broke on his refusal to trust his winners. That failure taught me that execution is nothing more than the mechanical application of a structured plan. The plan is the set of rules. The execution is the discipline to follow them without the interference of human frailty. You cannot allow sentiment to enter the transaction. The professional operates on a probabilistic edge, knowing that he will be wrong a significant percentage of the time. The difference is that when he is right, the market pays him 5 times what it cost him to be wrong. The amateur trades based on the hope of a high win rate, resulting in a system where his few large losses always overshadow his many small wins. You must reverse that dynamic. The battlefield of the market is therefore entirely psychological. The charts are the scorecard, but the rules are the constitution of your inner world. You must operate with the precision of a Swiss watch. If you lack the discipline to cut a loss in 5 minutes, you lack the psychological framework to survive 1 year. The market cycle never changes because human nature never changes. The same greed, fear, and arrogance that drove men to ruin 100 years ago are dismantling your account today. The rules are permanent precisely because the underlying psychology of the market crowd is permanent. The final judgment demands relentless accountability. If you cannot integrate superior execution derived from structured price and volume data into your permanent psychological makeup, you are fundamentally incompatible with the wealth transfer mechanism that is the modern market. You are either disciplined, or you are destined to be the counterparty to a disciplined man's profit. Choose your side now, or quit trading by tomorrow morning. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical, it is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.